I've spent 10 years on the charts and was unprofitable until 6 years ago I switched to volume trading. In this lesson, I'm going to show you 2 specific setups I use daily to find the most profitable trades. And the best part about it, these aren't theoretical concepts. These are ready-to-use, tested frameworks you can start applying to your charts today. I'm Anastas, and if you've been following along, this is the lesson where things get practical. In lesson 1 and 2, we covered the mechanics, how market action works, how price moves through aggressive and passive orders, what volume is, and what the volume profile components mean. Now, let's look at how this plays out in 2 specific setups. Setup 1 is what I call the volume accumulation setup. And this is the foundational setup because it's based on one of the most reliable things that happens in the market. Big players accumulate positions in sideways ranging conditions. And here is why. Because if you're trading a massive position, you cannot just slam in the whole thing at once, because in the best case scenario, you would move the market against yourself and on top of it get a massive slippage, if your order would have been even completely filled. So instead, you work your way in gradually, in a range over time. And that's why sideways price action often is an accumulation phase. The clue is in what comes after the range. After they accumulate enough volume, meaning entering full their positions, institutions and big market participants initiate strong, aggressive buying or selling activity to move the price in their desired direction. Based on this, we know that if there was a sideways price channel followed by a significant uptrend, strong buyers were accumulating their buying positions in this price ranging channel. If, on the other hand, there was a sideways channel followed by a strong sell-off, then we know that strong sellers were entering their selling positions in this rotation. Now you know in which area strong buyers or sellers enter their positions. So the idea is very simple. We enter the trade if the price comes back to retest this range. And to narrow down the accumulation area and find the exact zone for entry, we will use the volume profile to look inside this area and see at which price level the volumes were the heaviest. This will be the place where most positions were accumulated and where we will look for the reversal trade entry. In front of you, you see exact examples that I showed before, but this time with a volume profile on top of it. Look how the price rejects the same exact zone of accumulation and continues the previous trend. You only need to mark the exact level and wait for the price to return back to it. That was a long example, and here is a short one. Logic behind is exactly the same. Now, let's break down the setup in step-by-step process to make it super simple. Step 1. You find the accumulation and wait for the price to exit the range. Step 2. You take a volume profile tool and place it over the total accumulation phase. The volume profile will highlight the point of control as much as value area, and that is your point of reference. Step 3. When the price hits the level, you either enter the position in the direction of the previous breakout using the market order, or you place a buy limit order at the top of the value area high for longs and sell limit order at the value area low for shorts accordingly. No need to wait for any other sort of confirmation. You are good to go. This is how your long position will look like. Entry at value area high or point of control with a stop loss below the value area low. Volume accumulation zone in this case protects the price from breaking through against your position, so there is no need to place your stop loss below the low. And in case of short, your entry would be at value area low or point of control with a stop loss above the value area high. Makes sense, right? You want the volumes to protect your trade. Now you are trading with the same players who already moved the market once, and you are joining their defense, not fighting them, unlike 99% of retail traders do. If we dive deeper into studying any trading instrument, you'll start noticing that every one of them has its own volume pattern. The times during the day when the volume is low, the times when the volume increases. Repeatable spikes of volume around the same hours of the day during opening and closing hours of trading sessions. And in between this information, if you look close enough, you will also recognize that sometimes the volume spikes are not regular. They are sudden. They may be caused by the macroeconomical event, sudden geopolitical update, or just a big institution entering the massive position at this very moment. This sudden, unusual volume spikes is exactly what piques our interest in the next trading method, as they carry an important information about the intention of traders who push this volume into the market. So once you identify the sudden burst of volume and the candle this volume bar belongs to, you know that something happened there, right? Well, the next question is, logically, what exactly happened and where did it happen? To answer this question, we will use the volume profile. We will place our volume profile solely on the candle with a big volume spike to find its point of control and value area. These levels will answer the question, where did it happen? Or more precisely, where was the massive volume traded within this candle? The next thing we need to know is what happened and how did it affect the price. So after finding the point of control and value area, we check how did the body of the candle close in relation to the volume. Was it a full strong bullish candle with a closure above the point of control and the value area high? Well, in this case, you know that the volume that entered the market on this candle accelerated the price up and market accepted the high prices. Most importantly, how would you take a trade like this? Well, from here we can take a long at the retest of the point of control and expect the further upward continuation. Stop loss would go below the low of the high volume candle. Now, what if the situation is reversed and the body of the candle closed below the value area low and the point of control? Well, in this case, you know that the volume spike pushed the market down and traders accepted the lower price of this asset. Hence, you'll be expecting the further drop. You would take a short on the candle closure with a stop loss above the high of the volume candle. The price is likely to continue downwards movement since the volume will be holding the price from reversing against your short. By now, I showed you how this setup can work as a trend continuation. But can it also be suitable to find the reversals? Absolutely yes. In a matter of fact, for us, the previous market direction before the big volume spike doesn't really matter that much. What matters is if the price closed above or below the volume after. But what happens if, for example, the body of the candle closes around the point of control itself or inside of the value area? Well, it generally signals indecision and indicates that it's not yet the time to enter a new position. The volume might have come from the big institution closing their positions rather than opening new ones, and in some cases, the reversal might follow. So if the body of the candle closes within the value area and or close to the point of control itself, you just wait for as long as it takes until the price clearly shows you the next direction which the market participants picked. So you sit on your sidelines, sit on your hands until body of the candle closes below or above value area and only take a trade after depending on the direction of the breakout. Alright, I feel like that was a lot. Lesson number 3, 2 setups, same logic, just different market conditions. Go ahead and test it out on different markets and get back to us with your feedback. And if you are wondering if there is a way to make every setup even more efficient, In the next lesson, we move from volume profile into the order flow and footprint chart. It will change how you view the market completely, and you'll be able to treat it as standalone trading narrative, as well as use it for confirmation for the setups we've learned today. Like, subscribe, and hit the bell button to see me in the lesson number 4.